Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest. You ready? Let's dive in. A big welcome to our guest, Jaclyn Hester, partner at Foundry VC. Based in Boulder, Colorado, Foundry invests in startups and early stage funds. Foundry manages $3 billion for their limited partners across 70-some portfolio companies and 50-some fund managers. Jaclyn is a recovering lawyer turned investor. She has been with Foundry since 2016 and helped launch their partner fund strategy. Today, we get into Jaclyn's process as well as her approach to investing in funds.
Thanks for having me.
Jaclyn, can you share your LP career journey?
So I, as you mentioned, am a recovering lawyer. I would like to say I'm pretty fully recovered. I was not a lawyer for very long. It was about 5 minutes until I realized not a fit for me. I did the big law thing, I think, and I was in M&A, which I think can kill a career pretty quickly. I didn't know what an LP was. I would say, save for I'd probably heard about it in my venture capital class that I took in law school, and I ended up volunteering at an event where Jason Mendelsohn was there. He was one of the founders of Foundry, and he had been my professor for that VC class. I was like, I hate my job. I got to get out. I got to do something else. Get out of law. Will you talk to me about it? And so we had breakfast the following week, and he told me about a bunch of portfolio companies that maybe I could go work with that were in their universe or Techstars. And right at the end of the conversation, he said, do you have a finance or accounting background? And I was like, not really. I have an MBA, but I didn't focus on those things. It's like, well, I don't think you're qualified, but I'll introduce you to this guy, Lindel. He's joining us to launch a funds investing practice within Foundry. We don't hire people ever. We're sort of anti-hiring junior people, but he seems to want to hire somebody. So again, I don't think you're qualified, but I will introduce you to him. And that is how I became an LP to start out my career in venture. I really knew nothing about it. He met me and he said the same thing. He's like, I'm not sure that you're what I need, but I think you'd be really good at this. So you'll come launch this thing with me. It'll be 2 years. There is no path for you here at Foundry. I'm breaking the one rule they have, which is that we don't hire junior people. And you'll build an incredible network. I'll introduce you lots of VCs. You'll learn about investing. You'll learn how to invest in people. And then, you'll have this amazing network, and we'll find something else for you to do. So obviously I never left. That was 8 years ago. I'm now a managing partner at Foundry, and have shifted more to the direct investing side over time. We can talk more about that. But that is a very long-winded answer to your question of how I became an LP.
No, that's great. I resonated with me a lot because I had this inflection point in college when I had 2 internships, one at Cravath, Swaine & Moore, and one at an investment bank. And I quickly saw, I was like, I'm working just as hard, but this doesn't look as fun. And my bank account doesn't look like you guys. So law will definitely, that corporate law it can churn like no other.
Cravath is a particular thing.
Not knowing that.
Yes.
I should have done my research, but yes. Before we get into kind of the Foundry as an organization and then the plan to start this fund of funds, what did you quickly see in those first couple of months of this assumption of me liking to work with startups, it is true. And my background from the legal kind of perspective, this really helps in this way.
What I realized was that people who are starting VC firms or newer VC firms are kind of like startups. And so if the analogy for startups is, at least at that time, we probably weren't the pre-seed investor or even the seed investor in some cases. We were probably the Series A investor. And then for a handful, we were a little bit later stage. For a handful, we were earlier stage. Meaning that a lot of the firms that we backed were probably on fund 2 or 3, even 4. But there were a few where we were in fund 1. And so what was cool about it is, I think in general, it's hard to be a good LP because you have to find elements of edge and differentiation in something that has been very commoditized, which is we sell money.
Mm.
And VCs, we're middle people, and we take money from large pools of capital and we put it into startups, but we're not building those things. You're building a firm. But so learning how to find the ways that these things are interesting and different from each other in something that looks very commoditized on paper, and where it's like, okay, we have a fund of a certain size and we deploy money to early stage founders, is like, okay, how is that different from the other person that told me that they do that? At least like companies, I think it's a little bit easier to tell how their product is different.
Mm-hmm.
And so it was kind of a different way of looking at startups, where you really had to dig deep to figure out why something was special. And the special thing, which is, I would say, very analogous to startups, is that the special thing in early anything is the people. And in particular, in venture funds, it's really about the people. I would say there's a handful of firms out there that have done a really good job of making it about the firm broadly and not the individual people. But for the most part, it's the people. And so figuring out people's brands and how they think and how they make decisions and the team dynamics and why would they attract talent, and how they think about portfolio construction and portfolio management and all of that. And then building a network, which is kind of hard to do, where you have enough trust and enough of like a deeply embedded knowledge of, our small little thing that is early stage venture, where you can actually get back channel references, because that's like the most important and hardest thing. And then also just seeing enough where, you can know that you're picking what you think is the best. And so like if you're looking today at, the AI co-pilot for customer service, right? There's probably like 50 of those at this point. So I'll use something where I feel like it's actually pretty commoditized. And so imagine a sea of like 2,000 of those that are all kind of coming to market around the same time and popping up. And you're like, how is this any different from the other one that I saw? And so I just think learning that and learning it from Lindel, who had been at UTIMCO, and had seen kind of this emergence of the emerging manager and emergence of kind of this new set of early funds and kind of the institutionalization of seed, was a really cool way to learn it. But
so you kind of started into it a little bit, but I was curious on, there's GPs investing in other GPs is not a new thing, but to take the commitment to actually be an established platform and say, we're going to institutionalize this internally, like what was the decision making from that perspective? What opportunities did you all see? Want to do this? Yeah.
So the decision to do it was made before I came on, because I came on to help execute it. But then we kind of evolved it over time. But I know plenty about it. I did our last fundraise, so I can tell all the stories. So my partners, Brad in particular, but Brad, Seth, Jason, and Ryan had all been, those are the founders of Foundry, early on had been investing in the sort of new set of seed firms as they started to emerge. And so they were writing personal checks. They were relatively promiscuous. I mean, like they were writing checks to lots of people. They weren't like doing deep diligence on anything. It was people in their network. It was people like not even really in their network. And they were just trying to be helpful. Oh, by the way, it's great for deal flow if you're a Series A investor, if a bunch of seed investors like you and you help them get into business. But it's also all about like, I think Foundry's sort of like give first and contribute to the ecosystem and the startup community. And it kind of all comes back around. And frankly, like as a Series A investor, or like sort of the one round later, it's good to have a bunch of pre-seed and seed firms that have been raised, because you kind of get more funded companies to choose from. So it was, sort of good for us, good for them. And if you looked at it as a portfolio, which they weren't really managing as a portfolio, I mean, it was on the order of like 100 funds, probably. Great multiple. Like they did really, really well. And some of that is timing. Some of that is who they chose to work with. A lot of it's luck. And so, it was kind of this mix of, well, we think that this is good for what we do. We also think it's good for the ecosystem that we benefit from and take part in and want to see grow. And it's a good way to make money. Yeah. And so in thinking about that, and also Foundry, early on was kind of, we're not going to do this forever. We're going to have a number of funds and be done, and we're not going to shift away from it. I think it's hard to get to a point of like, okay, well, what would be next if we were going to evolve? And we have this one sort of core value that we call be joyful and experimentation. And so it's kind of like thinking about like, what could we do where we're doing something that we think great startups can be anywhere, right? That was like an early thing. And so we're in Boulder. We were early in Techstars. This was like another one of those, I think, like early thinking of like, hey, we see this, we've tested it enough, it's worked for us. What if we brought it to our LPs and let them benefit from it as well? More than just us getting good deal flow from it. And so at the same time, and I'm not sure that they were thinking about it before these conversations with Lindel, but at the same time, Lindel, who'd been at UTIMCO for, I think, 13 years and ran private markets and had, like a banger of a venture portfolio for certain vintages. Like it's all kind of coming to fruition now, but like USV's first fund, Foundry's first fund. He was in Spark early and like a bunch of really good funds. So he really wanted to focus in venture. He thought that early stage venture had the most alpha, was the most interesting place to put capital. And yet, as a giant institution, you can't really, for the listener who I'm sure knows this, but like a lot of these funds are 20 and 50 and $100 million. When you've got today $35 billion endowment, I think at the time it was probably 20 at UTIMCO, you can't be spending time, and you have a small team, you can't be spending time writing like $1 to $5 million checks or $10 million checks. You have to put the money to work. And so he couldn't really play where he wanted to play. He helped Michael Kim at Sandana startup. And so UTIMCO was like an early backer of them. And Sandana backed a lot of these sub $100 million seed funds. So he was getting exposure to it. He was close to it. And similar to me, it was like, I'm close to this thing, but I'm not close to it in the way that I want to be close to it. And so he was kind of, I don't know, he was turned 40 or something and was looking for the next thing. I'm close, but I'm not there yet, so it's on my mind. What am I going to do next? And so anyway, they kind of came together. He had been a longtime LP, and Foundry was like one of the first people that said yes to them. And so they came together. He loved Boulder and moved here, and we started this thing. And so the idea was, let's institutionalize what we've been doing with personal capital, but put it inside the fund. So the first iteration of it was a mix of, it was the first time we had done this. We still had a separate early stage fund at that time. This was 2016. We called it Foundry Group Next, very original. And it was 25% funds, 75% directs. But the 75% directs was a mix of an opportunity fund for Foundry's earlier stage portfolios, which we had done one iteration of prior in our Foundry Select Fund. That was like 2013. And then something we'd never done before, which was a later stage entry point. So you could enter at a B or a C, which is a thing that Foundry historically had not done. Through our Select Fund, kind of earned the right to say that we could do that. But what if we could apply that practice to what some of these partner funds are bringing out? We call them partner funds. I coined that, by the way. What some of these partner funds are bringing us. You can't call everything GP, LP. It starts to get really confusing as to like what's what. We call them partner funds. Anyway, so that was the first iteration. And then over time, we kind of put everything together. And so we just had a single fund, 25% funds, 75% directs. But the directs was everything we do from early stage to opportunity.
It's so cool to see how these pieces all come together. What were those early days like getting it up and running?
Yeah, it was fun. I really knew nothing at all. It's so funny to look back. One of the most fun things was, we would get on planes and run around, and I never even really traveled for work before. I think my first firm, it was based in Cleveland. So we got to go to new associate orientation in Cleveland in February. And so that was like quite luxurious. But I really hadn't traveled for work. So it was kind of fun. Like, we would get on planes and go to San Francisco and go to New York and go to LA. One of the first things I was tasked with was like, go figure out LA, should we have an investment there? And so a lot of what I did was just find the next generation people, find one person who was nice to me. Not everybody, not all communities are as welcoming as others. I would say LA was one of the ones where people were really welcoming. A shout out to Monique Villa, who was one of the first people I met, and so all you need is like one or two people to open up their network. And then all of a sudden you're starting to like be able to put things together where you're meeting like the firms that we'd be looking at. And then plus Foundry's network, obviously we had a portfolio. So we were obviously going to pick some of the managers we were already invested with to invest with. But as far as like the emerging side of things and the next gen side of things, that's where I was focused. But to have context for that, I got to do everything. So it wasn't like, it was like, hey, you go meet the next gen managers and I'll do all the established stuff. We just did everything together. And so I had the context of what good looks like, between Foundry and then all these other firms like Founder Collective and Freestyle and USV and Forerunner. And I'm going to leave some out and they'll be mad. But like a lot of the more established folks, I got to learn from what good looks like and see how to apply that to the next generation and what we might want to be different for the next generation. And so, I mean, it was tons and tons and tons of meetings. And what was fun at the beginning was we would walk out of a meeting and Lindel would say, okay, you're writing a check. Like he wouldn't say anything and he would ask me to go first.
Yeah.
And at the beginning, like I was writing everybody a check because I'd never been around interesting people before. I'd been around lawyers. And all of these people were like, had interesting backgrounds. And especially at that time, if you got into venture, like you probably had a relatively interesting background and had a lot of experience hearing about their investment theses and their portfolios and like all the cool tech and robots and all this stuff that they were doing. It was like way cooler than anything I had been around. So I thought everybody was awesome. And then over time, I think you go from like everyone's awesome and then you go to no one is awesome. Like you have to kind of have the drop first. And so then I became highly skeptical and a little jaded and then like kind of, balanced out somewhere in between. I very much like and am fascinated by people. So I trend positive, but you have to have the context over time. So that was fun to learn. And I would say we did a lot of running around, but it was nice to already have a set that we knew we wanted to do. It was more about like waiting for their timing. And something that was super cool was getting to have allocations in firms that were sort of like inaccessible. And that was the Lindel's background and reputation and my partners at Foundry's background and reputation. I'm sure they liked me just fine as well. But we sort of got into some sort of top, limited access firms because of that. And that was pretty cool to get to be part of those things as well. And then just meeting the other LPs was really interesting. So it wasn't just about meeting the VCs, but then starting to learn the LP world. And, I remember that I knew what a family office was because when I was a lawyer, we had a trusted estates practice. And I remember being like, so is a family office, is it like an office that this family goes to? And that's where they I already had like made that stupid comment when I was a lawyer. So I knew what a family office was in some respects, but I didn't understand the level of investing that they do and how some of them are really institutional and how some are really not. And sort of the wide range of like how VCs raise their money. So getting to kind of see all sides of it was really cool.
Was there a certain, did you guys have a different ideal customer profiles for the different managers that you wanted to fill? Or did it kind of just ebb and flow on the different opportunities?
Yeah, so I think there was like a high level, there was high level parameters around what the fund ought to look like or not look like, and then the people. And so I'd say on the fund side, we were mostly looking at sub 100 million. We would do some that were a little bit larger because it was an established manager that we knew or because that strategy made sense. Those were more of exceptions. So we did a lot of smaller funds. We liked the alpha and smaller funds. We also wanted to make sure we weren't backing funds that we might be competitive with. So it was like important that they kind of like, be the rounds before us. So I think that was important. Portfolio construction mattered to us. So with some exceptions, most of the portfolios were in the category of like 25 to 40 companies, buying most of their ownership up front. So we liked that. Most of them lead. So that was important to us. And then there's and US focused. We really didn't do much other than Blue Yard, which was an existing relationship outside the US. And then we don't do biotech or life sciences. So we didn't back biotech and life sciences firms. Great way to make money, also great way to lose money. And we didn't really feel like we had expertise there. And we didn't really do much in CPG or a lot of consumer. We did Forerunner, but sort of different style of consumer that we could underwrite. So some of it was, standalone has to be a great firm and we have to believe in it, underwriting it as an LP. And then also we wanted to overlap with Foundry in some way, shape, or form. So we looked at we have plenty of Bay Area firms. We also have firms in New York and LA, but then in between, that was important to us. And then there's the people side of it. And so the people side of it starts with the sort of top of funnel, good humans. That's a more positive way of saying no assholes, but I like saying good humans. And then sort of filtering into, are these people exceptionally smart and thoughtful, and they have a thesis and can articulate what it is that they look for? Do they have an amazing reputation? Do people love working with them? Are they talent attractors? Are they dynamic where a lot of people want to be around them? And then have they built a fund and a firm that plays to the strengths of them as individuals or as a team? And so kind of looking for GP strategy fit. Mm-hmm. So those were kind of the general things that we thought about. We like to get to know people. So we weren't super slow. We weren't as slow as a large institution, but we also weren't just willy-nilly writing checks. And then I will say one thing that was an interesting adjustment for Lindel was in negotiating the LPs. You asked me this earlier, Ernest. It was helpful to have a legal background because I could actually understand the documents and run that process. But he had to adjust from being a $50 million or $100 million check to a $1 or a $5 million check, and the negotiating leverage you have at that stage changes. And so we quickly shifted from the demands of what the LPA must look like to which I still do today, which I think is really the way to do it, which is we would give them the checklist that our firm would put together. And our firm that represents us, we work with, he's now at DLA Piper, David and Sarah over there. They would put together this checklist, same one for each LPA. And it was the institutional version, right? And so we would show it to the GP and we would say, here's all the comments you're probably going to get if you start to raise from institutions. Here's the 4 comments we're going to make that we really care about. Mm-hmm. But you should know what these all mean. And let's work on it together versus let's put the lawyers against each other and spend a lot of money. Yeah. You need to understand how your document works. And so that was kind of our shift once we realized that being 10% of what you once were is very different.
Well, that is a real gift that you offered those managers on what to expect when they did start talking to the current Lindels as opposed to the past Lindels.
Yes.
With this explosion, in the past 8 years, the number of first, second, third funds has exploded. Did your process have to change?
I think I don't know if it's because of the explosion of funds or because we just got into our rhythm and learned. I think everybody's process evolves over time. I would say that the same things that mattered to us still matter to us. We probably started to say no to initial meetings a lot more, which early on, I really tried to meet everybody and anybody and be helpful as much as possible. And I still want to do that, but there just are so many. So I think we had to have a higher top of funnel filter. And I think the what we would spend time on, or sort of when we would really dig in, shifted. And so I think we would get better at saying no more quickly. Because and then once you have the context and you're seeing everything that's out there, you can do it more quickly. But I don't think we ever felt the need to go a lot faster. I think it's more about being able to scale so that you can handle all the inbound. I will say, well, one thing on that though. I will say that with especially in the 2020 to 22 timeframe, where a lot of and this is kind of like the other version of emerging managers, which is like emerging managers that didn't have a lot of investing experience, which I think has shifted, and I don't think we'll see nearly as much of that. But I think if you wanted to look at some of those, and we did at least like entertain that world, you had to find non-track record ways or non-developed track record ways, which is like, I think definitely hard for institutions to underwrite the managers. And so you had to find things that were analogous to what you think a good manager does in that person's background. And so I think that was a little bit of an adjustment.
Now we're going to take a quick break to speak with our sponsor.
Next up, we have our industry expert and sponsor, Brian Huber, fund partner at Gunderson Dettmer. PitchBook has named Gunderson the #1 law firm globally for investors 10 years in a row. Our guest Brian's practice focuses specifically on structuring, forming, and operating VC funds. I have used Gunderson in my own fund formation, and I can highly recommend them. Thank you, Brian, so much for your advice and expertise. Any other advice for managers who are preparing to raise in this environment?
Yeah, so I would say distinguish yourself, and it's sort of a short clip, but I would say distinguish yourself based on your attributes and your strategy, and not based on your fund economic terms. I think, especially in an off market, you see people start to get creative, and that's great. And I think you see new things come out of that. But with institutional investors, especially, and I don't want to speak on their behalf, but when terms start to look different from the norm, especially in venture, the initial instinct is, all right, what are you doing that's like getting you a better term here? Even if it's like it's a lower management fee rate. All right, but where are you picking that back up somewhere else? And I think it just creates a little bit more friction that you don't necessarily have to deal with if you just go out with what we consider standard terms. And that's what, you rely on your professional advisors to tell you is this is standard. It might seem like a lot to you, but people are used to seeing this. And if you drop it, they're going to think that you're trying to get them somewhere else. But that's what I would say. I say, differentiate yourself based on your strategy and not based on your fund terms.
I love that idea. Yeah, it's like you're the new kid on the block. No need for you to be the one getting too creative. And any parting words for limited partners?
Yeah, again, I think LPs, you're in a really good space right now. You have the bargaining power. I think you're probably, especially for institutional LPs, in a place where the denominator effect has been corrected to some extent. I would say use this as an opportunity to explore new managers, take a deeper dive on some that you might not otherwise have done so. And reevaluate what you're asking for. I think you're in a position to ask for more, but that doesn't necessarily mean you should ask for more. I think it might be an opportunity to focus on ways to really support your managers. And again, that's me saying that from the perspective of someone who represents primarily sponsors. So I'm a little bit biased, but I think LPs are in a great position right now to really dictate, how the recovery, if we're calling it a recovery, looks in the ecosystem. And so I think that's good stuff.
Would you say 2024 is going to be a healthy vintage if people are just sort of on the sidelines and trying to decide if they want to be participating in venture right now?
I think it is. I think it just seems like there's a lot more just frothiness, if that's a word, in the deals. I think people are energized. They're well rested, I guess. I don't think it's going to be a 2021 where it was just like form a fund every day sort of thing. But I do think that periodic corrections are necessary in order to sort of make sure you're on the right track. And I think we're on the right track. And I think this year will be the start of a pretty good span. Historically, this summer was a time, especially with European investors, where there's just not a lot that's going to happen.
Crickets,
and so don't read into that. If you're not getting responses, that means that we're maybe back into the normal cycle of things where people take vacations. But I think don't lose sight of the ultimate goal, and keep at it. And I think we'll all benefit from it.
Sounds like a furious fall.
Exactly. I love, and that's how it should be. That's how it should be.
Brian, it's been a pleasure. To get in touch with Brian or any of the other lawyers at Gunderson Dettmer, please visit gunder.com. That's GUNDER.com. And now back to our LP interview.
Could you talk a little bit, like, I wasn't going to ask this, but like, could you talk about what did work for you, whether it was like specific questions or different tactics that you tried to do to back channel?
In doing diligence on firms?
And doing diligence on like non-track record.
Oh, yeah. I
Um,
don't think if we actually did any of those, if I think about it. There were, I think we didn't do a lot of those. I think to the extent that we did, they at least had angel track records.
hmm.
But the number one thing is attracting talent and making decisions. And then if there's a team dynamic, you have to vet the team dynamic. And so a lot of it was just understanding like who this person's network is and why they see deals. And, to the extent that there's an angel track record, can you take that and extrapolate that person could write bigger checks? And so a lot of that's talking to the founders and verifying that they would have taken a bigger check or that person's super helpful. Another thing that I think is interesting in general, and you can't hold people to it, is just where did you choose to work? Right. And so some people like made really good choices. Like, so for the people that had more of like the tech career that ended up in venture, making a choice of where you work in some ways is an investment decision, right? 100%. You're investing a bunch of your time. And so those are the types of things that you could do to at least see like how their decision making goes, and then talk to them about that. And then for operators, I think obviously like successful founders is one thing you can see that they kind of created a thing, made a bunch of investment decisions, hired a bunch of people. And then, for many that became VCs had a good outcome. So that's like a good way of testing that. But even like, I think that people that have product experience make good investors. Because you're like, because of just like how that lends itself to like you're researching a product idea, you're deciding if you should bring it to market. So for some of those people, you could kind of talk through like what they did at their particular place.
Jaclyn, you spoke about how like over your career at Foundry, you've transitioned more to direct investing. And it kind of takes me to the alignment of like a Series A fund is going to start a fund to fund of pre-seed and seed funds so they can get increased deal flow. That's good in theory. How do you execute on that? And what were some of the learnings for that?
So many learnings on that. So a couple of things I think that we learned were true over time that didn't know were true at the beginning is that we were pretty early in doing this. I would say, I won't say we were the first, but I would say we were early, and like over time you saw a lot of GPs mostly writing personal checks, but a handful kind of having an allocation in the fund. But it doesn't just happen that you write someone a check and then they send you all of their deals. And so then in that case you're being reactive. And so I think one of the things was just realizing like we needed to get really organized around it, and we needed to be knowing the portfolios and watching them develop and identifying if you have a company, your cap table in some cases have a ton of investors, but for the most part, you have like maybe over time, 3 to 10 to 15 investors that matter. When you're like an emerging manager in particular, or you have seed funds, you have like hundreds of LPs over time. And so like, you can't constantly be thinking about what each of them wants to do. And we lived this on the other side, being a manager that had LPs that wanted to co-invest with us and figuring out what that needed to look like to actually work. But in any case, it was on us to kind of monitor the portfolios, know the companies really well, and come to these like check-in meetings that we kind of proactively set up with a prepared mind and with a list of companies that we already thought was interesting, because there's just so much adverse selection. There's so much bias when you're already in a company. And, there definitely are cases where we would identify something and a manager would be like, not that one. And so those relationships can help with that, but it doesn't mean that they're not biased. And so I think it's on the LP to figure out what is it that you want to invest in, what would be a fit for you, and then messaging that and keeping it top of mind for the GP early on, and meeting the founder in a way that's not, disrespectful of their time or not like way too far in advance. So I think that was a learning that it's like, you really have to create a program around it, and you have to be super proactive. I think another thing is that you have to remember that, and not all, because some like early stage firms do a lot of Series A, but for like pre-seed and true seed managers, they're not necessarily good Series A investors, right? Like there's a reason that they do what they do and that they choose the stage that they stage. You can't outsource the work to them and the decision making. And so like you have to understand where they're biased, where they're, what they're good at, and then bring your own lens. But using and you get to know the managers well too, right? And so like even on a given team, right? We'll call them Sheila and Marge. I don't think anybody in our funds are named Sheila or Marge. And I'm sure Sheila or Marge will call me later and be like, "What the hell in your portfolio?" And like there are the types of firms where Sheila like loves every deal and is calling you, "This is the best deal ever," and Marge never says anything. And so when Marge pops up and says, "Hey, you should really look at this one," then you pay attention. But it takes time to get to know those things about the different people. Or like Sheila's really good at dev tools deals, so when she sends you a marketplace, maybe not. Ragging on Sheila a lot, but in any case, like I think you have to get to know the managers. You have to do your own work and be proactive. And then a fun cheat, which you can't rely on, but is a kind of a fun cheat, is you see who presents at the annual meetings every year, because most firms are putting who they think their best founders are up on stage. And so you can kind of track. We always joked that you could just like run a fund by just doing whoever presents at the annual meetings. I wish I had actually tracked that to see what the returns would have been. But yeah, those are some of the learnings. Oh, one last thing. I would say for us, we're a VC firm, right? And we have a reputation. We're known. So if we want to meet a founder, I think it's easier to say like, "Hey, this known brand wants to meet with you." If you're an LP that isn't known for direct investing, which is most, you have to be really thoughtful about your asks and thinking about like, what do you bring to the table? And you're more of a co-investor, whereas we were more of a lead. And so thinking about what it means to be a co-investor, you got to move quickly. You have to know what your process is. You have to know what value you can add, things of that nature. And so I think that's another thing that maybe was different for us.
Yeah. When we would send out our, quarterly LP updates at Jesse Draper's firm, and Tim Draper would write back and say, "Can I talk to that company that you just gave us the update on?" We always knew we had something good. So, Jaclyn, would you recommend this strategy to Series A or growth funds now that you've sort of seen how it all worked for you?
I wouldn't recommend it as like a thing everybody should just do, right? And I think a bunch of firms tried to do it, and a lot of them I know that tried in the crazy time have shut it down. And I also don't think that the time that everybody did it was the right time to be doing it, right? Like now would actually be a great time to be doing this, which we are doing. And so what I would say is that I think you have to think about why you would do it and then what it should look like for your firm. And if you want to bring it inside of the fund and but by the way, LPs hate fees on fees. You all know this. So if you're going to have a significant portion of your fund in it, you have to understand like that may change your fee structure, all sorts of things. And they also take longer to return. So that changes things. It's not for the faint of heart. But what I would say is if you want to do it as like a real strategy that's going to be where you're going to really invest in setting up something that's going to be core to your business, you're spending a lot of time with the managers. What we liked is I think of it as a filtered set of opportunities to focus on because there's so much noise out there. It's nice to just be focused on a set. And it's like, well, we think these managers are great. We underwrote them ourselves. Most companies that come to us have already raised a seed. So why not have some focus on this? I don't think you can cut off the rest of the world to it because you have other networks and you want to look at other deals that are interesting. But it is a nice way to proactively focus on a set of deals where you have an information and a relationship advantage. And I would say the relationship advantage is much higher than the information advantage. But I do think that if you're going to do it, you got to focus on it and actually spend time on it. Whether that means you spin up something that's real and you hire someone with experience doing it to run that, or it's more like, hey, we're going to write some checks as the GPs. you still probably want somebody focused on it, but maybe you're not investing in as much in it. But like anything, like you sort of get out of it what you put into it. And so I think if you're going to do it, like you need to have a real strategy around it, have a sense for what you're trying to get out of it. But I will not discourage GPs from writing checks to emerging managers, because that is the way that most emerging managers get into business. And so I think it's important for the ecosystem.
Jaclyn, where it feels like it's a inflection point in the industry, or I'm just almost 40, so I think everything's at an inflection point. But if you do believe that,
Can we start a new podcast called Almost 40?
Almost 40. Yeah.
Get a bunch of people who are almost 40.
I just got 6 months. But where do you see the industry going?
Most people
in the next
think
decade?
Ernest and I are like 25, by the way. So it is quite surprising.
Yeah, I get the same thing.
For
I
our,
told someone
our
the
audience.
other day, and they were like,
I promise I'm 40. Yeah.
These are three 39-year-olds. In case you don't know what 39 looks like, it's this attractive.
Hey, I'm 37, guys.
She's 30. We have a young buck.
You guys
here,
are old.
So, yeah.
What I hope to see is that people who love it, because you have to love this work to do it. Yes, you can make a lot of money, but it's I'll credit my partner Ryan with this. He calls it get rich slow, and then I've added get rich slow, comma maybe, because a lot of people do not make money doing this, and especially if you're starting out small, like you don't really make much in management fees, so it's all about carry, and you may not make much money in carry if your fund doesn't perform, and you won't know that for 15 years or 10 years, and you've already dedicated your career to this, and so you can't really switch. So it's a hard thing. There are better ways and better asset classes for making lots of money, which include hedge funds and PE and buyouts and things like that. So I think it's like, I think that it kind of goes back to like, either the tourists go away, the people who love it really want to do it. My hope is that you get people with like just new perspectives on how this should be done, attracted to the industry. And I think like what I would like to see is some of the back to basics stuff, which is like making the fund size make sense, having a real strategy and having some discipline around it. I really wonder what will happen with the multi-stage firms. I don't know the answer to that, but I think it's really hard to return good multiples on those kinds of sums of money in the billions of dollars. And I hope that early stage founders get smart to the idea that if you take money really early from one of those firms and they don't continue to back you, you might be kind of fucked. And so we'll see what happens with all those and whether they can raise. But I think there's a bit of correction. At the same time, got a lot of people, as you know, like Foundry, we made a decision proactively that we're not going to raise more funds. These funds take 20 years to manage out. I am the youngest, I like to say by far, than my partners. And there wasn't really like a next generation. Like I said, like it kind of wasn't set up to do that pretty adamantly. So I didn't expect that. You're
the only person they ever hired. Yeah, you're the.
I know. And
rule breaker.
Yes. So I'm likely to start something new in a couple years after we finish our investment period, but I will always sort of be connected to Foundry and still help with my Foundry work and work with the founders. I get excited about like just generational shifts, and I think that we're heading into one, and I think it's going to be a good vintage. What happened with the bull market is a lot of LPs that never touched venture and hated it saw like, oh shit, I missed out on making all this money. So we now have to have a venture program. That's the exact wrong time to be starting your venture program. And so a lot of those programs started and will probably stop pretty quickly because of the change in valuations that people have seen and just the craziness. And so what I'm excited about is for the folks that are really smart, I think there's the LPs that will continue to do venture as they always have consistently. But then I think the people that we attract in this next 3 to 5 years of this vintage 2024 to 27 or whatever it is, I think they're going to do great. And so that's really exciting for sort of the future of the industry.
Thanks so much, Jaclyn.
What a good time.
No, this is great. We really appreciate your perspective and just walking us through your own journey and learnings. If people, especially amazing founders, want to find you, how do they get in touch with you?
So my email is on our website. If you're smart enough to figure that out, you could find me. I'm on LinkedIn. I'm trying to blog more. So like I'll put my blog posts up on LinkedIn. And I make my way around. But yeah, I'm focused in direct investing, Series A and B. So please holler at me.
Thanks so much for joining us.
Absolutely.
You did great.
Such a pleasure, you two. Thanks for doing this.
See you later, Allocator.
After Portfolio Tile, investing with a smile.